with a vendor's lien, saying, well, I didn't get my money. I got the first lien against the property here, I didn't get paid. Everybody's upset. Bank is upset. They thought they had the first lien. All of a sudden, the seller's got a vendor's lien in front of us. We can talk about those priorities in a minute. The point is, then it hits the fan. Everybody in the deal calls their E&O coverage, their errors and omissions insurance policy coverage. The seller's lawyer, who didn't go to the closing because he trusted the title company, is nervous because his seller didn't get the money. Title company is, the point is these type of things happen. I'll tell you, a classic one. The new thing where you can take a photo of a check and send it to your bank and they deposit it into your account, and that works. We've had sellers who sat there at a closing. The seller sits there and says to the title company, you know what? I'll be glad to have your check. I trust you, and I don't want to wait for a wire and everything. Just give me a check for $400,000. Title agent says, cool. Mr. Seller, here's your check for $400,000 made out to the seller. That's good. And the closing parts and everybody leaves, and the seller comes back an hour after the closing and says, you know what, I've changed my mind. I really don't want the check. I think I do want a wire now. Here's your check back. I'll give you your check back. Wire the money to my account somewhere. Title agent says, okay, wires the money. But the seller has gone outside and with his cell phone has taken a picture of that check and has deposited it into his account, and the bank has cleared it already. And that check that he has handed back to the title company never needed to clear because it cleared by phone. So then the title agent, the wire goes out, and all of a sudden the title agent gets a call from his bank that says you're overdrawn by $400,000. Well, what do you mean? Well, you issued 2 checks for $400,000 this afternoon. You made 2 payments. Well, no, I didn't. I only made 1. I got the check right here. And they go, well, that one cleared too. So that's another one. The games, the frauds are we will never come up with a way to eliminate all the fraud. I mean, if we said cash, people will print cash, and you'll get counterfeit. You know, I mean, so the gamers are out there, and the guys, the hackers who are lurking to undo these wire things, it's getting huge, and they hack somebody's email, and they're smart, and they're somebody who's worked in a title company or attorney's office before, and they understand the flow of a closing, and they know how to wait till just the right timing. In other words, if they had sent that email 5 days earlier and saying change it to wire the money to Texas, the title company probably would have had time to say to the seller when they sent him the deed, you sure you want me to send your money to Texas? And they would have said, what? But it happens at the end when everybody's in a panic and everybody's in a hurry, and we're going to talk about that panic in the changing landscape section at the end. But it's like anything else, tax returns, anything. There's always going to be fraud. And what we've tried to do is eliminate forged cashier's checks with using wires, but now people change wire instructions. Wires are good money and are irreversible as hell. The moment a wire hits and the money is deposited to the thief's account, it's over. There is no, hey, just kidding, send it back. And the money's gone. All right. Good point. There's no stopping the fraud. It's just taking a different form now. There is a federal law that regulates a little bit about what goes on at a closing that I want to talk about a little bit. And it's called RESPA, R-E-S-P-A. It's the Real Estate Settlement Procedures Act. You know, we talked early on that most law regulating real estate is state law. Excuse me, but the feds have a law called RESPA. I think it was passed in the early 80s. Nah, maybe late 70s. Late 70s. RESPA is the Real Estate Settlement Procedures Act. Real Estate Settlement Procedures Act. I just want you to be a little bit familiar with it and understand its limitations, because you're going to hear, remember we want to talk about vocabulary, you're going to hear people talk about RESPA. And I want you to know, though, the limitations of what RESPA applies to. RESPA is it's a federal law that requires lending institutions, whenever there's a new bank loan, to disclose a bunch of information and to get certain forms signed. But here's the limitation of it. RESPA applies to 1 to 4 unit owner-occupied dwellings. In other words, it has to be a new loan with a federally insured bank for the feds to be involved with this. And it has to be a 1 to 4 unit residential property. You know, a duplex, single family, of course, a duplex, a triplex, a quadplex. And the buyer has to live there. Okay? If you hit on all those bases, RESPA applies. What that normally means in the context of our course is RESPA is not going to apply, because hopefully we're talking about commercial deals here. But it has a lot of effects on a residential deal where the buyer is going to live there, and where the buyer gets a new loan in the drawing like we came up with. The whole idea of RESPA was to allow consumers to shop around for closing costs and to be able to compare apples and apples, because every bank spoke a different language, and one bank would charge you 2 points here and another one would charge you an originating fee here, and the idea was to try to compare lenders and let buyers try to find the best deal so that they were able to compare them in a residential situation. So they require when the buyer applies for a loan, they get a settlement cost booklet. It's a big book that nobody's ever read that explains all you ever need to know about borrowing money for a house. They're required at the time of the application and again before closing to give a bunch of disclosures of all the closing costs. And in these situations, they do it. The most important lingering effect of RESPA is something we're going to take a look at in a minute. And it's called the HUD-1 settlement statement. HUD, of course, is who Housing and Urban Development, Department of Housing and Urban Development, cabinet position. Trump appointed a new secretary of HUD, Ben Carson. HUD is who regulates RESPA. And when this thing was passed, I think it was 78 or 79, one of the big things they were trying to do was create a uniform form of a closing statement nationwide. Every lawyer and every title company had their own form of closing statement. Debits and credits, like a balance sheet or something, and we'll see one in a minute, but the point is, everybody thought that their form was the best, and they were not only different from office to office within a city or within a county, but they were different, really different from state to state. And HUD decided that in any one of these transactions where it's going to be a residential loan closing, 1 to 4 units, there should be a uniform form so that people could travel from Alaska to Virginia to Florida and see the same form of closing statement, so it would look the same. Because people that move a lot in jobs and everything are having to buy a house every year, and they want them to learn one form and then understand the form. So they came up with this closing statement called the HUD-1, HUD-1, and it's the uniform settlement statement that RESPA, through HUD, required to be used nationwide. Well, real estate lawyers like me and everybody else in the whole country went ballistic, saying, you can't tell us to use your federal form for closings. We've been doing closings for 200 years here. What the hell do you guys know in Washington that have never been to a closing? And everybody fought it like hell for years and years and years, because nobody liked the form, because everybody thought their form was better. And remarkably, here, 30 years later, we've all kind of come around to understanding the HUD, and we all pretty much use the damn thing now. And remarkably, even when it's not required, we use it, because we've all gotten used to it. And secondly, what made it much more palatable was after a year or two, computer programs started coming out that would produce the thing and would calculate all the numbers for you. And once everybody bought a computer program and got used to it, then we all got used to the HUD. We're going to go through a HUD closing statement in a minute in a deal that was not a RESPA deal, and it was not required that it be used. But frankly, we all just got so used to it, and we got computer programs for it after bitching and moaning for all these years, that now we use it in most deals because everybody's used to it. So that's really the big lingering thing that RESPA did. And interestingly, even though RESPA's impact is residential 1 to 4 units only, the closing statement that was mandated there has been adopted for $100 million deals on factories. I mean, it works because people now understand the thing. So let's talk a tiny bit more about RESPA, and then we'll go look at a HUD 1 closing statement. The other thing that RESPA did, and this is big and this is good, is to abolish what were called abusive practices. And those were basically kickbacks and referral fees. In the old days, if you go apply to a bank for a loan, the bank would require that you buy your insurance from the agent that's the president's brother, and that you get your survey from the president's son-in-law. And maybe the bank would pay kickbacks to these agencies, or these agencies would pay kickbacks for the referrals to the banks, and money was flowing right and left, and it was all kind of the accepted practice, and everybody did it. But Congress decided that increased the cost of borrowing money, and they were probably right, because those referral fees, and they're all get, you know, it's like anything else, it's all going to get plugged into the price somewhere. So basically, Congress abolished all those things. It's right. Kickbacks, referral fees, you know, banks used to pay brokers. Banks used to have contests with real estate brokers. We'll send the salesman from your office to Hawaii this year, whoever brings the most loans into our bank branch, you know. Well, you can't do that anymore. And so, in that sense, RESPA did a good thing to abolish kickbacks and referral fees to try to bring down the cost of a real estate closing, because there are a bunch of costs. Basically, just to understand so that we're finished, and I think we've touched on this already, but after the closing, all these satisfactions are going to get, at the closing, the documents are going to be recorded, the deed and the mortgage. After the closing, the releases and satisfactions of those mortgages, the releases of those judgments, the payment receipt for the taxes, all that's going to get done. And at the end, the title policy gets issued. The bank gets the title policy, and the buyer gets the title policy, and the closing is over. The buyer at the closing got the keys, went into the property, got possession, maybe. There may be tenants in there or whatever, but I mean, normally if it's a house and the guy's going to live there, you get your keys, you move in. That's kind of what happens in a closing. Let's take a look now at a closing statement. The form that I sent you. And I'm just going to highlight a bunch of things to you. And one of the good things about this form is that every entry has a line number, so it's pretty easy to follow it around. So please take a look at the HUD, at the closing statement that I sent you as a sample. This is a doozy of a deal, as you're going to see. Not because the numbers are so crazy, but there are so many weirdo things going on in this deal. I chose it for that reason, and it is a 11-unit apartment building, so it therefore is not covered by RESPA, but the closing agent decided to use the HUD 1 settlement statement form anyway, because we were all used to it. The one other thing I want to say to you is the real HUD 1 settlement statement today is now about 6 pages long. Basically, as between the buyer and seller, it's still pretty much like the first page of this one. but they're just pages going on and on of disclosures from the lender to the borrower and stuff like that. If you're required, if you're doing a RESPA deal, then you got to use that new form. But obviously, if you're not doing a RESPA involved deal, then you use the, you can use your old form if you want to. So this is the old form that we're still using today for deals where we're not required to use the new one. So let's just walk through this deal, and I think it'll give you the drift of the functions of the settlement agent, as we talked about in collecting all the money and recording all the documents and paying everybody. Upper left, you'll see this is a HUD-1 settlement statement. That's the name of this form. HUD's form. Item D is the name of the borrower. Well, that's the buyer. The borrower, the borrower's getting a new loan here. And we can use our example there, but we're going to have different numbers here. But the idea is the borrower, buyer, is the same person, is getting a new loan. So the buyer here is an LLC. The seller is another LLC. The lender is the lender making the new loan that's a part of this transaction. The address of the property, the settlement agent here is the Walton Law Firm. That's the person who was issuing the title insurance and therefore did the title exam and therefore prepared this closing statement and is going to handle all the documents and all the money and all the recordings and all the payments. The settlement date here, 3/21/06. And just so you'll know, that says the property location. We don't need to use a legal description on this. We use a legal description in all the other documents that we're going to record. But here, it can certainly be a property location. We know what it is. And just so you know, again, this is an 11-unit apartment building in Coral Springs. That interestingly, just to have this in the back of your head, the buyer was buying an 11-unit apartment building and intended to convert it into a condominium to sell condominium units, which explains a lot of the weirdo numbers we're going to see. Now, anytime that you have a HUD-1 settlement statement, you always start with page 2. You start with page 1 to see what are we doing here, who are the parties and what's the property. But to get the flow of the transaction, you have to go to page 2. Page 2 is all of the closing costs. And as you can see, they're beaucoup here. Lots of them. And every one of these closing costs is something that's going to have to be paid by the settlement agent with all the funds that the settlement agent receives. As we look at these closing costs, on the right-hand side, you see 2 columns. Paid from the borrower's funds at settlement. That means either money the borrower, the buyer, brought in, or new loan proceeds from his new loan. And next column to the right, paid from seller's funds. In other words, seller's entitled to a certain price, but there's cost to be paid. So these are the things we've got to net out before we're going to pay the seller. So the first thing we're going to do on line 703 is pay the brokers. Their commission is $92,500 in this deal. And there are 2 brokers here, line 701 and 702. One was the listing broker, who got $52,500, and the other one was the selling broker, who got $40,000. How they worked out that split between them, I don't know, I don't care. The total commission charged to the seller is $92,500. Now that's section 700, the realtor. Section 800 is loan costs. The buyer, as you're going to see in a minute, was borrowing. We've got a new loan of $1.8 million. In conjunction with that loan of $1.8 million, there were a bunch of costs. These are the lender's closing costs, the loan costs, and of course the buyer has to pay them. So all these things get charged to the buyer. A 1% commitment fee, a 0.25% commitment fee to some mortgage broker, a tax service fee is nothing, a flood determination fee is nothing. This is attorney's fees on line 805 to the bank's lawyers. The bank has lawyers to prepare all of its documents. The buyer, the borrower, pays the bank's attorney's fees. and the bank's attorney's costs on line 806. And there was an appraisal fee. The bank went out and got an appraisal, and the appraiser has to be paid $6,000. So all of these are costs of the new loan paid by the buyer for the privilege of borrowing $1.8 million. Line 900, there's nothing in there. That's about like paying first year's premium on insurance policies and stuff like that, but that had already been paid. Reserves are something we're going to talk about in a minute. Those are escrows, you know, where banks escrow taxes and insurance and stuff like that, and they have to fund up these accounts while they weren't escrowing in this deal. But they did create a couple of reserves here, which means amounts held back out of the loan proceeds. A $25,000 renovations reserve, that was to renovate the apartments so they could sell them as condos. And an interest reserve of $145,000. That means the bank held back $145,000 to pay itself interest every month until the payments kicked in. So these are things that are carved out of the loan proceeds. Now there are a bunch of title charges. These are the costs of the title insurance and stuff like that. So there was a closing fee on line 1101 to the closing agent. There was a title search fee to the closing agent paid by the seller, the $295. Title exam fee of $475. There are attorney's fees here to 3 different law firms who got involved. I forget who represented whom. And Ackerman Centerfit is a firm, Michael Torres is another firm. These are all attorney's costs charged to the buyer. In addition, the cost of the title insurance on line 1108 is $7,537. Now that's the cost of the title insurance, and that is for, as you'll see in a minute, our purchase price is $1.9 million. So at only $7,000 worth of title insurance to buy $7,000 of title insurance premium, that's the one-time cost of the title policy, to buy $1.9 million worth of title insurance. And this shows you here on line 1109 that provided, or 1110, that provided coverage to the buyer for $1,975,000 as purchase price. And here, I told you it was usually $250 more. Here on this deal, it was only $25 more. They paid to get a policy for the lender for its $1.8 million. And there's some special endorsements of the title policy, but all of these things are costs of the title insurance and title search and title examination. They're all here in section 1100. In section 1200 are the recording fees. These are the fees that had to be paid to the recording department to record our documents. And there are fees for recording the deed, fees for recording the mortgage, fees for recording releases of paying off some satisfactions and stuff, and those get spread over the parties here. Some are charged to the buyer, some are charged to the seller. There are taxes due. There are 3 types of taxes, 2 on a mortgage and 1 on the deed. The 2 on the mortgage, lines 1202 and 1203, $3,600 and $6,300. Those are called the intangible tax and the documentary stamp tax, and those are costs of borrowing $1.8 million. As you can see, for example, line 1202, they're borrowing $1.8 million. 2 mils on that is $3,600. 3.5 mils is the $6,329. That's those costs. The other tax, the documentary stamp tax. The biggest one is line 1203, and that's the state taxes on the deed. These are the recording fees, you remember, that were shown up on a deed when a deed's recorded, and this is how everybody figures out what the purchase price is. This is 7 mils, which is $7 a thousand on the purchase price. So based on the purchase price of $1,975,000, the doc stamps on the deed, as we call them, are 13.8, and that's the one the seller pays, because that's a tax on the deed. The others are taxes on the mortgage, and they're all paid by the buyer. So those are all recording fees that the title agent has to take out of the money and use to record all these documents. And then there are a bunch of other costs. There was a survey, $1,650, that the buyer charged, being paid for here. There's some courier fees, a bunch of miscellaneous Mickey Mouse, FedEx's administrative and UCC filing fees, and utility search fee, and some additional expenses on another page. Page 3 is a joke. It's another $600 for something. Some landscape guy didn't get paid or whatever. In any event, the importance of all this is, and the reason we do this first, is to figure out what are all of the closing costs in the deal. And here at the total at the bottom of the page are all the closing costs in the deal. The total closing costs to the borrower are $240,000. That sounds huge, but of course, $160,000 of it were those two reserves that were created up there. So they're not really closing costs, they're just things taken out of his loan proceeds. And the closing costs to the seller are $107,202, and that's the biggie is the broker's got $92,500. Really, the seller's normal big costs are the broker and the doc stamps on the deed, and those are the bulk of the $107,000. Now we can go back to page 1 because we know what everybody's closing costs are. So let's go back to page 1, and page 1 is broken into two parts. Let's go through the left-hand part first, which is called Summary of the Buyer's Transaction. This is sort of like the buyer's closing statement. So, in section 100, here are the amounts the buyer owes. The buyer owes the price of $1,975,000, right? The buyer owes his settlement costs of $240,000. There's some sort of funky thing here called a contribution to seller's costs. That's something the seller negotiated in the contract. Rent for a vacant unit. What that was about, this is a weirdo. For the month prior to the closing, the buyer used one of a vacant unit and rented it out from the seller as a sales office for these condo units. So this is paying rent for one of the vacant units that the buyer used for a month before closing. The point is, you get down to line 120. On line 20, you see that the buyer owes in this deal $2,218,000. That's how much it's costing the buyer to close, $2,218,000. Now, here in line section 200 are the amounts he's paid. Well, he paid a $70,000 deposit. He borrowed $1,808,000. That's his brand new loan. And then this is a really funky thing. The seller in the sales contract agreed that he would make a contribution to the buyer to help the buyer with his closing costs of $362,000. That's strange. That's not normal. I'll tell you about that in a minute. And in addition, line 209 is called the seller's credit for lease security deposits. Let me explain that to you. There were tenants in the building, and the tenants have all paid security deposits on their leases to the seller, right? When the buyer takes over and those tenants move out, one by one, the buyer has to give those security deposits back to the tenants. This is where the seller then gives those security deposits back to the buyer. Because the buyer, one by one, is going to have to refund those when the tenants move out. The tenants had paid in $9,185. On 11 units, that's what, maybe $800 or $900 a unit. And so the seller has a liability, really, of giving those back, so he gives the buyer a credit for it, and the buyer assumes that liability, and the buyer will have to give it back sometime. So that's a credit to the buyer, because the security deposits are going to have to be repaid to the tenant someday. So, in addition, follow me here on taxes for a minute. These next section called adjustments, these are what we really call prorations. On the real estate taxes here, we're about $20,000 a year on this piece of property. We closed, as you saw, on March 21, 3/21, okay? Taxes, we know, go from the beginning of the year to the end of the year. The bill comes out on November 1. And they get paid by the end of the year, or, or they become delinquent or whatever. But the point is, here we are at 3/21. The bill's not even out yet. What are we going to do? Well, last year the bill was 20 grand. So you divide that by 365 and you find out, what are the taxes per day. The seller has owned the property for about 2.5 months, right? We're March 21st. We're 2/3 of the way through March. The point is, the seller has owned the property for January and February and 21 days of March. So you take the per diem taxes and you multiply it times, what is that, 60, 81 days, right? You know, really, let's assume they're all 30-day months. Really, there's 31, and there's 28, and there's 21, however many days that is. That looks like that's about 80 days. Okay? For 80 days so far this year, the seller has owned the property. The seller should pay 80 days worth of taxes, right? But the bill's not going to come out till later. So we figure out what's really 80 days worth of real estate taxes based on 20,000, and 80 days is what, less than a quarter out of 365 days, something less than a quarter. So we figure out based on those days that the seller's share of this year's taxes is $4,337. The buyer's going to have to pay the 20 grand at the end of the year. There's only going to be one bill, and the buyer's going to get it, and it's going to be $20,000, and the seller's going to be long gone. The buyer's going to have to pay the whole 20 grand. So the seller's share was $4,337. So a buyer gets a credit for that now. Simply, the buyer gets a credit now for $4,337, and the buyer pays the whole 20 grand bill at the end of the year. That's apportioning, that's prorating the taxes between the buyer and the seller. We don't have the bill now, we can't pay the bill now, the buyer's going to pay it. Let's take the seller's share out now. We do a similar thing here on rents.
Not to complicate things, but the day of closing belongs to the buyer, correct?
The what?
The day of closing belongs to the buyer.
Some contracts say one thing, some say the other. Okay. Some say you prorate as of midnight the day before the closing, and some say you prorate as of the day of closing. So different people do it different ways. And that would determine whether you would plug into this March 20th or March 21. Right. Okay. Now, we do a similar thing on the rents. Follow me through on the rents here. Rents for the month of March. I'm not really trying to teach you how to do this. I just want you to get the drift of why we're adjusting this. March rents were $10,000. Who got it? Seller owned the property on March 1st. He got it, right? He collected the whole $10,000, has the $10,000 in his pocket. Well, we're closing on the 21st. The buyer is going to own the property from 3/21 to 3/31. He ain't going to get any rent. The tenant's not going to pay him again. I already paid the seller for the whole month. So let's get the buyer back 10 days worth of rent. Seller keeps the whole 10 grand that he collected from the tenants. And let's get some rent back for the buyer. So here, line 213, March rent collected by seller, prorated from 3/22, which is the first day that the buyer owned the property, to the end of the month is $2,745. We give the buyer credit for it. Seller keeps the whole 10 grand. Okay, that's a credit to the buyer. Total credits to the buyer here now are $2,257,000. Now this is the strangest deal you've ever seen, because the total credits to the buyer of $2,257 are bigger than the total charges to the buyer of $2,218. When you put all that together, the buyer gets money back at the closing of $38,000. That shows you how bass-backwards this deal was, and I'm going to explain that to you in a minute. But let's go through the seller side for just a second. On the seller side, we've got a lot of the same figures, shown a little different. The seller, line 401, is entitled to $1,975,000. He hasn't received anything yet. He's supposed to get $1,975,000. In addition, on line 104, the same line 404, the buyer had agreed to pay $2,100 towards the seller's closing costs. And now he gets that rent for that vacant unit of $1,137. The gross amount due seller is $1,978,000. So seller should get $1,978,000. What's he going to get here? Well, in this strange deal, the seller had already received the deposit of $70,000. Usually that hasn't happened, but the seller in this case said, "I'm holding the deposit." So you have to reduce by the 70 he's already gotten. We have to reduce by the 107.2, which was his closing cost from the next page. We have to pay off his first mortgage loan. Seller had a first mortgage on the property. We got to pay that off. The balance due on that mortgage is $278,420. The seller agreed to make a contribution to the buyer's closing costs of $362,500, so here's where he makes the contribution. We have to take away from the seller that $91.85 for the security deposits, because he got to keep them. So we have to take that away from the seller because he already has that money. He has it, but he gets to keep it. He never has to give it back. The seller has to pay his share of the taxes here, which we calculated were $43.37. And the seller has to give back that 10 days of rent, which was $27.45, because the seller got to keep the whole month of March. The reductions in the amount due seller are $834. The seller's entitled to $1,978,000 on line 601, less his reductions of $834. The seller walks out with cash of $1,143,000. That's how the closing statement works. All of this money came into the closing agent, and the closing agent has to write a check for every single one of these things you see. Everything you see here. All these listed items, except for a couple. Because a few of these things on the first page, like we talked about security deposits and taxes and all that, that money doesn't really come in. That's just credits and debits between the buyer and seller. Now, let me tell you for 2 seconds what was going on in this deal. This was a huge scam. The seller was willing to, let's say, go along with the buyer's scam. Here's what the buyer was doing. This property, you see this $362,500? It was the seller's contribution. What this deal was really worth. This property was worth $1,600,000. That's really a good price for this property. Worth $1,600,000. I think the seller had it listed for $1,600,000, or maybe $1,700,000, but the seller was willing to take $1,600,000. So a buyer comes in being real cute. He says, "I'll tell you what, let's increase the price to $1,975,000. And I'll tell you why in a minute. And then, Mr. Seller, you give me a credit of $362,000 towards my closing costs. And then really our purchase price is about $1,610,000 or something like that. You know, we're back to a real number. Here's why. Banks will only loan based upon the purchase price. They wanted to borrow $1,808,000 from the bank. We can't borrow $1,808,000 from the bank if the purchase price is only $1,600,000. Let's jack up the price to $1,900,000 and then say, seller, you just give me a credit towards my massive closing costs of $362,000. Then, with a purchase price of $1,900,000, a bank can loan $1,808,000. And it did.
He has his renovation costs.
And here's what happens. None of these units ever got sold. This interest reserve here on line 1108 of $145,000, that took care of the payments for like 15 months, which was supposedly the marketing period for this buyer to market his conversion condo units and get them all sold. So the bank paid itself every month for about 15 months out of that interest reserve. And when that ran out, it came time for the first payment. By then, the borrower had figured out that this deal ain't ever going to go. We haven't sold any units. He never made a payment. Who do you think ended up owning this thing? The bank foreclosed. And the bank had $1,808,000 in this deal. But it was really only worth $1,600,000 at best. This was in 2006. This is the kind of crap that went on that led us to the mortgage crash in 2007. There was an appraiser here you saw that got $6 grand. I guarantee you the appraiser appraised this property for more than $1,975,000. What he probably did was said, oh, 11 units converted to condo, they say they're going to sell them for $200,000 apiece. What's 200,000 times 11? $2,200,000, right? Something like that. So let's appraise it for $2,200,000. then it's okay to loan $1 million either way, based on 2 of it, looks like a nice safe loan. But the property was only worth $1.6 million. Now, the seller really didn't care. He's happy to call purchase price $20 million. He doesn't give a damn as long as he gets his $1.6 million. So this was the buyer's scheme to let's jack the purchase price up to $1,975,000, had the seller give me this credit, which really gets the seller the same money, but by getting the price up, we get the bank to loan more money, which they did, and the whole house of cards all crashed, and the bank ended up owning the property. And this is why banks fail, and this is why we have the housing crash, because of stupid deals like this. So, this could be a very normal closing statement with normal figures. And look what the buyer did. Think through what the buyer got here. The buyer paid a $70,000 deposit, right? And he got back at closing $38,000 real dollars. So the buyer paid $32,000 for an 11-unit apartment building, for $32,000 for an 11-unit apartment building worth $1.6 million. For 15 months, he got to lease it out and collect all the rents, never make any mortgage payments because they were in the interest reserve. And then when the payments hit, all of a sudden he said he didn't pay anybody, so for $32,000, the buyer got to handle this property for like 1.5 years and collect the rents, not pay anybody anything. And the bank ended up holding the bank. These are the kind of deals that cause the market to explode. And clearly there's an appraiser here who got $6,000. He gave an appraisal fee to the bank. The bank gets to sit back and say, we had an appraisal to $2 million too. This looked like a good loan. When these things really hit the fan is when the FDIC takes over the failing bank and has a bad loan. And then they try to figure out how the hell did this happen? And they start going after people. They start going after the appraiser. They go back to the seller. The seller says, I disclosed all this stuff. The seller is totally safe on this. This is all on the closing statement. If the $362,000 had become sort of an under the table payment or whatever, then there's a fraud. All this stuff is disclosed. It was all in the sales contract given to the bank. It's all in the closing statement. The bank just either badly wanted to make the loan or didn't care, or somebody had the appraiser in their pocket, and in any event. So picture what's going on in the closing statement. You've seen all that. At the bottom of page 2 then, this is when I told you the closing, in step number 3, the closing agent pulls out the closing statement and everybody signs it. On the bottom of page 2, it's signed by the borrower, it's signed by the seller, and then look at this little legend below those 2 signatures. The HUD-1 settlement statement, which I have prepared, the closing agent, is true and accurate, and it is. I have caused or will cause the funds to be dispersed in accordance with the statement signed by the settlement agent. At the bottom, warning, it is a crime to knowingly make false statements on this form. Nobody made any false statements. They just made stupid decisions. This is a closing statement, and this is how the deal works. And this form works, and the concepts work, where we talked about paying off loans, where we talked about prorating taxes, where we talked about prorating rents. You know, if a property has tenants, unless you close on the 1st of a month, you're going to have to adjust rents. You know, somebody collected the rents, and they have to share them. Unless you close in December after the taxes have already been paid, and in fact close on December 31, you're going to have to prorate the taxes one way or the other between the buyer and the seller. So all these concepts apply in every deal. Now, I'd like us to look at one thing for a second, which is the changing landscape section at the back end of this chapter, which is on page 483. I'd like to read you a line or two about how things really happen in the closing and get the drift of where this goes. The changing landscape section at the end of Unit 19, page 483 of the 9th edition, second paragraph. It says, in contrast today, the contrast they're talking about is what we used to do in Old England. Well, that's real nice, who cares? In contrast today, the conventional closing often occurs 30, 60, 90 or so days after the parties have bound themselves by a real estate contract. That's the period we talked about here. Signed the contract on May 1, did all this work, closed on June 1. The closing occurs 30, 60, 90 days, wherever the parties negotiate. Moreover, the conventional closing today involves a number of persons beyond the buyer and the seller and involves mounds of paperwork. Buyers and sellers usually sit in some anxiety as paper shuffles past them, and they are obliged to sign document after document. Although each document is clearly titled and probably comes with a bit of an oral explanation, not even the attorneys representing the parties read the documents completely. I won't concede that, but that's what this says. Each year, new forms are added to the cadre of documents. Federal mortgage regulations, state law, and the lender's policies continue to enlarge the heap of paper. There has to be an end to the paper mill, and there has to be a better way to accomplish the closing. Although federal law requires that the real estate settlement form be in the hand of the purchaser at least 24 hours before the closing, this rarely happens. Well, that's only in a rest of the deal anyway. There's no federal law that regulates what we do in other than a RESPA deal. But even in those RESPA deals, supposed to be in the purchaser's hands 24 hours of closing, so that you can study the closing statement and see what goes on. But it rarely happens. Thus, the parties and or their attorneys are rushed at the closing and pressured to sign the documents as the settlement clerk instructs, oftentimes finding out too late that mistakes were made. There has to be a better way. But that's where we are, and that's how it happens. And usually everybody's not sitting around the table, and these are done by, the documents are sent by email and signed and delivered by courier, and the money is wired around, and sometimes the brokers are just running around delivering packages of documents, and theoretically we're all having this little sit-down closing where we smile at each other and shake hands and sing kumbaya, but it just doesn't happen. But that's what we're trying to accomplish. We just accomplish it in pieces. Okay, that's the end of our chapter on the closing. Any parting questions on that?
Yeah,
Yes, sir.
on the HUD 1 form, where was the $32,000 that the buyer profited from?
Let's say that one more time.
Where was the $32,000 that the buyer profited?
What's the difference?
The difference between
The 70 and then the what you got in the bottom, he was talking about the difference.
where's the 70 again?
And I'm not following you yet because I didn't hear you. What is the what?
Yeah, I didn't realize the 32,000 was the difference between the 70,000, but I'm not sure where the 70,000 is located.
The $70,000 deposit, that's the buyer's deposit.
Oh, okay, the buyer's
That's on
deposit.
lines 201 and 501.
Okay.
Is that what you're talking about?
Yeah.
Okay, yeah, that's the buyer's deposit. That's, we said here that maybe in this deal the buyer had put up $50,000 and it was going to come into the pot now to be part of the closing. Well, in this deal the deposit was $70,000.
Okay, so the difference is the 20,000. Whoops, sorry,
Well, in this deal, it was a $70,000 deposit.
Yep.
In the deal I dreamed up an hour ago, it was a $50,000. You're not trying to compare these two deals, are you?
Oh, no.
Okay. So what's the 20?
His original question was, where did the $32,000 come from in the deal on the, in the HUD?
Okay, the buyer put $70,000 in the pot,
Yeah.
okay? At closing, the buyer
Receive over
got back $38,000.
Okay.
See that line 303? Usually, line 303, here's what line 303 usually is. Line 303 is usually the $200,000 that the buyer still owes. But because of all these hokey numbers, there was so much money in the pot,
Yeah.
they didn't know what to do with it all. So they had to give some back to the buyer. So the
Because the property was
$32,000 that
valued.
I was referring to is the difference between the $38,000 the buyer got back and the $70,000 he had put in.
Gotcha.
So you're really only out 32.
Yeah.
All right. Anything else? Okay. Let's move to the final section of our text. As you know, we're skipping chapter 20, which was that escrow closing thing that we talked about, that we just don't do it that way here. And as we move to the next section, we're now talking about how do we finance a deal. Although we go through cycles, basically without financing, we don't have much of a real estate market. Financing of some type in some way. So we've got two chapters here on how do we finance deals. One on the way we really finance them, which is mortgages. And then we're going to spend maybe a half an hour total on chapter 22, which is called agreements for deed, whenever we get to it. But it's rare. What's really going on here is mortgages. That's chapter 21. This is a long chapter. We'll spend the rest of the day on that. And then probably some more of next time. Financing is what makes deals go. Rarely do people have $1 million cash to plop down and buy a piece of property. They got to borrow $750,000 of it. We're going to talk about how do you get that $750,000? How do you apply for it and get it? What kind of documents do we use? There's a lot of stuff going on in this chapter, but it's about mortgages. So let's talk about what a mortgage is. And you remember we had a chapter on involuntary liens. Well, this is the one voluntary lien. This is a mortgage is a written instrument that uses real property to secure the payment of a debt. Simply put. Now, let's talk about secured debt for a second. You know, debt is simply an IOU. I owe you money. I promise to pay you money. And we'll talk about the form of that in a minute. Secured debt is debt with collateral. Secured debt means any debt where if the debt isn't paid, the lender gets to sell something to pay the debt. The lender has security, are the words we use. If it's a car loan, the lender has a lien on the car. If it's a boat loan, the lender has a lien on a boat. If it's a real estate loan, a lender has a lien on real estate. The point is, security is something the lender gets to resort to sell to pay itself back if the debt isn't paid. That's secured debt versus unsecured debt that has no security. A mortgage is really the best type of secured debt because you know you can hide an airplane and move a boat, but you can't really move real estate. It's going to stay there, and it's mighty good collateral for a loan. So we use real estate as collateral for a loan, and we do it through a document called a mortgage, which is a written instrument that uses real estate to secure a debt. There has to be some sort of a debt for a mortgage to be valid. You cannot have a mortgage unless there's a debt. Okay. The debt is evidenced by a note, N-O-T-E. It has lots of names. It's basically a promissory note. In its purest form, it's a promissory note, but it's also called a mortgage note, a real estate note. There are all kinds of names for it, but what it boils down to is it's a note. And here's what a note is. A note is a written instrument signed by a borrower containing a promise to repay a loan under certain terms. That's all it is. It's a promise to pay. It's an IOU with terms. Terms about interest, terms about how it's to be repaid. That's what a note is. Now, we're going to look at a note in a second, but I want to be sure that you've got these two concepts in mind. The note reflects the debt. The note contains the terms of repayment, but the note reflects the debt, because we said there has to be a debt. And the mortgage acts as security for the debt. So the mortgage secures payment of the debt. The note reflects the debt. The mortgage secures payment of the debt.
So the mortgage is what encumbers the property.
We're going to talk about that in a minute. It creates a lien on the real estate.
On the real estate.
Okay? Yeah. We're going to discuss that concept in a minute. I want to go through the note in a minute, and then we'll talk about the mortgage. But I want to make sure that everybody's straight on a note and a promise to repay. But that's exactly what it is. Mortgage, as you're going to see in a minute, creates a lien on real estate so that the real estate can be sold to pay the debt. Just like the car can be sold to pay the car loan, the boat can be sold to pay the boat loan. The real estate can be sold to pay the mortgage loan, to pay off the note. Let's look at a note for a minute and get the drift of a promise to repay. And then we'll look at a mortgage, see what it does. Please look at the promissory note that I sent you, entitled Promissory Note. And then we'll just talk about a couple of the highlights so you can see what's going on here. As you can see at the top, this one's entitled a promissory note. It could easily be entitled a mortgage note. This loan was for $731,250. And as you see in the first couple lines, you see what's going on here. The undersigned, Progress Limited is the name of the debtor here. The maker or the borrower is the best way to say it because everybody understands who the borrower is. So the borrower promises to pay. That's IOU. I promise to pay you to the order of City National Bank, the lender, the sum of $731,000. Together with interest thereon on the outstanding balance at the rate set forth below. So this borrower promises to pay the bank $731,250 with interest as set forth below. First little paragraph. Now we're going to talk about how's it paid. Commencing on March blank, that's 1 month after the closing, and on the same blank day of each month thereafter, this loan is payable only, interest only every month. This is a great loan for a borrower. All he has to do is pay the interest. So he only pays interest every month, once a month, on the same day of the month. It next tells you how interest is going to be calculated. Interest is calculated on Citibank's base rate. That's the rate. Most notes will say 7%, 6%, 12%. Well, this note is based on whatever Citibank's rate is. And right down the middle of the paragraph, it says the rate of interest shall be adjusted daily. So every month, the bank is going to send a bill to the borrower and say, you had 12 days at 7%, you had 6 days at 7.25%, and then you had another 12 days at 8%. You owe me da-da-da-da for that month's interest at Citibank's rate. Borrower sends in a check, pays his interest every month. The next paragraph is called the maturity. The entire outstanding balance, together with all accrued interest, should be due and payable to the borrower to the lender on the blank day of August 2005. You can see that's 2.5 years. This was a 2.5-year loan. It matured in 2.5 years. Interest only every month. Pay the balance back in 2.5 years. On the next page, 3 paragraphs down, is something we're going to talk about at length in a minute. It's the acceleration clause. This says, basically, if you miss a payment, the whole balance is due. We'll talk about that shortly, but this is a sample of an acceleration clause in the 3rd paragraph on page 2. In the 4th paragraph on page 2, talks about default. We're going to talk about what a default is. We talked about default under contract, default under a lease. Anytime you don't do what you promised to do, you defaulted. This is what happens if you default. Next paragraph, this note is secured by the mortgage. Remember, we said the mortgage secures the note. This makes reference to it. This note is secured by a mortgage. That's basically the drift of what's going on. Now, there's 7 pages of provisions here. Or 9, I can't remember how many. I only printed these 2 pages. All kinds of what ifs. What if you don't pay? What if this? What if this? What if this? Bottom line, borrower promises to make a payment according to certain terms. That's what a promissory note is. Okay, now that's the note. There has to be a note, there has to be a debt in order to have financing. So now let's talk about a mortgage. A mortgage in Florida creates a lien against real estate. I want to contrast that for a minute with the way it's done in other states. You don't really have to memorize this, but I just want you to be familiar with it. Not every state treats mortgages like Florida does. In some states, the lender actually holds title to the property. Some states do something called a deed to secure debt. Under a deed to secure debt, the borrower deeds the property to the bank. The bank holds title until the loan is repaid. Then the bank deeds it back. Now, they let you live there, let you use the property as long as you're making your payments. But the point is, in some states, those are called title theory states, the bank actually gets title of the property. I'm going to do that in Florida. Other states use something that's called a deed of trust. Georgia's big on this, deed of trust. The property is deeded to a trustee. The trustee holds title during the term of the loan for the benefit of both the owner and the bank. At the end of the loan, if the loan's repaid, the trustee deeds the property back to the owner. If the loan isn't repaid, the trustee deeds the property to the bank. Okay, that's a deed of trust. That's what they do in Georgia. But those are both states where you're taking the title away from the borrower and giving it to the lender for the term of the loan. We don't do that in Florida. Florida is a lien theory state. Like the text says, most states are lien theory states. Remember we talked about liens, mechanics liens, judgment liens? Liens are a claim against real estate, we said, so that the collateral can be sold to repay a debt, to repay a mechanics lien, to repay a judgment. You can sell the real estate. Well, this is a lien. This is a lien on property to secure a debt, and if you don't pay it, your property gets sold to repay the debt. A mortgage creates a lien on real estate. Okay. A mortgage has a mortgagor and a mortgagee. Now, it's fairly often in the mortgage context, we do use mortgagor and mortgagee. I told you we try to stay away from that, but unfortunately, I'm not driving. And I would like documents to always say the borrower and the lender. So that's real clear of who's who, who's borrowing, who's lending. The borrower, of course, is the mortgagor. The lender is the mortgagee. Sometimes better documents say borrower and lender, but a lot of people stay with the traditional mortgagor and mortgagee. Creating a lien on real estate to make sure that a note is paid. So let's look at a mortgage for a minute. Just get the drift of what's going on here. This mortgage, I think, is about 30 pages long that I sent you, which is short to medium length. A lot of them are 100 pages. Very few are less than 8 or 10. Looking at this document, you can see this is a first mortgage. It's got the name of the borrower. It's got the name of the bank. Got the amount of the loan, $731,250. We're on the same loan, same as that note was. Forget this future advances of $3 million. It's got a land legal description on Exhibit A. On a separate page is going to be the legal description of the property on which the lien is being placed to secure the payment of the note. Now let's just look at some of the operative paragraphs of what's going on here. At the bottom of page 1, borrower hereby grants, bargains, sells, assigns, transfers, and conveys. Remember, those are the same words that were in a deed. We do use those words traditionally in Florida, and we say, and mortgages to bank. By our Florida law, even though this is a grant, bargain, sell, transfer, our law says this does not transfer title to the bank. This just gives the bank a lien. So here at the bottom of the page, borrower mortgages to the bank, that's the language that counts. The land described on the land, which is described on Exhibit A. On page 2 now, together with, here's what the bank gets a lien on. Well, we already gave them a lien on the land, We just said you got a mortgage on the land on Schedule A, together with. Now, remarkably, I hope a lot of bells are gonna go off here. You're gonna see half a dozen at least terms that we've used already in other chapters. I'd like you to see there is some real applicability of the crap we've talked about. It's for real, it appears here in these documents. We use it when you read the document, now you're gonna know what it is. What are we giving the bank a lien on? The land together with, number one, the appurtenances. The benefit of all easements and other rights of any nature are pertinent to the land. Well, that would be an easement appurtenant, wouldn't it? We've talked at length about easements appurtenant. So we give the bank a lien on any of our easements appurtenant in the middle of the paragraph, together with rights of ingress and egress. 2 lines further down, together with our water rights, our oil, gas, and mineral rights, our riparian rights, together with any reversions or remainders. Basically, anything that goes with the property, the bank gets a lien on that too. And hugely in paragraph 2, and a lien on all the buildings and structures, because that's what the bank's really interested in. That's nice to have a lien on your land, but they really want a lien on your building. And in number 3, the tangible property. These are the fixtures, together with borrower's interest in all fixtures that we talked about. In little I, attached or affixed to the land. And towards the end, regardless of whether physically affixed or capable of severance, this is all the stuff we talked about on fixtures. Chapter 4, together with the rents. This is maybe the most important thing. This is where the income comes from the property. Together with the rents, issues, incomes, and profits arising in any matter from the land or the improvements or the appurtenances, including the borrower's interest in and to any and all leases. The bank really wants a lien on your leases because that produces the income that makes the mortgage payments. Number 5 is not really relevant. Number 6, you give the bank a lien on all proceeds that you may receive from condemnation or from insurance. If the building burns down and there's insurance payable, the bank has a lien on it. Condemnation, if the government takes your land away, the bank gets the money. In the middle of the next page. Number 8, the name. You give the bank a lien on your project name, like if you're the Galleria. That's a big deal. When the bank takes the property away from you, they want to be the Galleria. They got a lien on your name. Down under number 10 then. The land, appurtenances, tangible property are all collectively referred to as the mortgage property in this mortgage. So basically from here forward, now they're just going to talk about the mortgage property, because all these things are bundled together in what you pledge to the bank. And then a real important paragraph right before number 2. Notwithstanding the grant of the borrower's interest in the rents, space, so long as no default shall exist hereunder, or under the loan documents, borrower shall have a license to collect and receive all income from the ownership operation of the property, including the rents, but not more than 2 months in advance. So the bank is saying, you gave us a mortgage on your leases, you gave us a mortgage on your rents, we're going to be nice guys and we're going to let you collect it, as long as you're making your payments. The moment you're not, we get the rents. Okay, that's what the mortgage does. Now, there are 20-some pages of you have to do this, you may not do that. But that's the drift of what a mortgage does and how a mortgage encumbers real estate. Okay, how do you get one of these things? We're assuming you're dealing with a bank. Not necessarily, but usually, for the sake of our example, we're going to call it a bank. How would I get one of these things? Like, how would I get a loan? Well, you go into the bank and you apply for it. You might go to a mortgage broker to apply for it. But simplistically, you go sit down with a loan officer at the bank and you say, I want to borrow $750,000 so I can buy this $1 million piece of property. Great. Tell me all about your deal. Tell me all about your piece of property. Tell me all about you, all about your credit history, your assets, your payment history. File an application. Beg me. And you fill out all that stuff, and you hope the bank will approve your loan. If the bank approves your loan, you get the all-important document that we're talking about in a commercial context. you get a commitment letter. You need to know what a commitment letter is. A commitment letter is a bank's letter approving your loan, but it contains all the terms of the loan. It says, we'll loan you $750,000. We want interest at 6%. We want to be paid every month. We want an appraisal. We want a survey. We want title insurance. We want insurance. We want 3 kinds of insurance. We want to make sure the title is clear. It's got a bunch of conditions in it. But basically, it's your loan approval letter from a bank. It's called a commitment letter. Now, the bank signs it and asks you, the borrower, to sign it. When you sign that, you now have a contract with the bank. You have a loan contract with the bank. It's called a commitment letter. And the bank agrees to loan you the money, and you agree to borrow the money. This is a contract that you negotiate just like a real estate contract. The bank may give you a commitment letter that says, we'll loan you $750,000 and pay 7% interest, balloon in 6 years. If you're a strong borrower, you say, nah. You cross out the 7% and you write 6%. And you cross out the repayable in 7 years and say, I want 10 years. You sign it and send it back to the bank. If it's your first deal ever, they laugh at you and say, okay, well, sorry for you. But if you're a good customer and you've done a lot of deals with the bank, you're negotiating a loan. Just like you negotiated with the seller your sales contract, you know, where you negotiated the price and the terms. Now you negotiate with the bank the price of the loan and the terms of the loan. So it is a negotiable contract, negotiated just like a real estate deal. The amount to which you get to negotiate is all based upon your strength. How good a customer of the bank are you? If it's your first deal ever, you sign it real fast and say, yes, sir, thank you for the loan. But as you become a good customer and you have 7 loans and good payment record, and then you start negotiating terms. No, I want a better rate. If you don't give me a better rate, I'll go down to the street to this bank. So you haggle it. But the point is, once you both signed it, and once you both agreed on all the terms, you have an enforceable commitment. You have an enforceable contract. That's called a commitment. And the bank will require you to pay, at the time you sign and accept that commitment, a non-refundable commitment fee. Now, we're talking about a commercial loan here. We're not talking about a $60,000 house loan where you had a $300 application fee. The bank will require you to pay a non-refundable commitment fee. It may be as much as 1%. In our example here, they may say, write me a check for $7,500 when you accept this thing. That is non-refundable. And here's why. Here's the bank's attitude. We, for the several weeks until the closing, have set aside $750,000 of our money. And we are committed to loan that money to you. And we got to keep that liquid, and we got to keep that available for whenever your closing is. So you have caused us to set aside $750,000 of cash that we can no longer have invested in other loans. We've got to save it for you. And the cost of that is 1%. And you're paying us that 1%. And if you decide not to close a loan, okay, thank you, we keep your 1%. If you decide to close the loan, well, we also keep your 1%. But you don't have a loan. It's the cost of getting the loan. That's called the commitment fee. It goes with the commitment. And it's non-refundable. So, you got a commitment now. You got approved. You negotiated it. You got it all signed up, all initial, all the changes applied. You paid your commitment fee. What are we going to do now? Well, we're going to work our way towards a closing. We need to understand the concept of what these documents are going to do, these loan documents, and now we're going to talk about a lot of the, I don't know, kind of the facets of the transaction and what's going on, both maybe before closing and as contained in the documents. This kind of blends both. But the idea here is to give you the drift. The text calls it the rights and obligations of the parties, but it's just kind of understand what the mortgage does to you, what your position is as the borrower, what the bank's position is as the lender. First is the issue of possession. And possession goes with rents and profits, just like we talked about before. The bank never gets possession, even in those states where you deed the property to the bank as to secure the debt. The borrower still keeps possession. Now, the bank gets possession real quickly if you default, and that depends upon the different states and the different types of foreclosure. But then the bank's going to come into possession if you don't make your payments. We'll talk about default in a minute, but the point is, if you don't do what you said you do and don't make your payments, then the bank's going to take possession. But up until then, you get to be in possession. You get to collect the rents, likewise, as long as you're making the mortgage payments. The bank expects you in two different ways, actually 3 different ways, to protect their security. Their security is the land and a building. The first thing, they of course expect you not to commit waste, not to let the property deteriorate, take good care of the building. Why are we taking good care of the building? Because the bank may take it away from you, and they'd like it to be in good shape. So you have to keep it in good shape. The other 2 things particularly we're going to talk about because they affect your monthly payments. The bank expects you to keep it insured. Bank requires you to keep it insured. And you remember we talked about the 3 different types of insurance policies that the buyer was going to go out and shop for. And the bank is going to make you shop for. Fire and extended coverage, policy type number 1. Policy type number 2 is windstorm. Policy type number 3 is flood. You're going to go out and buy 3 different types of insurance policies. You're going to name the bank as a beneficiary in those policies. And if anything ever happens and a claim is payable, the claim's going to be paid, the money's going to be paid to both you and the bank jointly. Because the bank's real interested. If the building burns down, the bank doesn't want you to be paid. They want to take their $750 out of the insurance proceeds. And of course, in this case, the amount of the insurance that they're going to expect you to have in all cases is what? $750,000. You might want to have $1 million. They're happy for you if you do, but they're going to require you to have $750,000 because they want enough insurance to pay them off if the building burns down, or the hurricane blows it away, or a flood washes it downstream. So the bank is going to require you to insure the property, and the other thing the bank is going to require you to do is to pay the taxes. Every year the real estate taxes are going to come due. Remember we talked about the lien of real estate taxes? What is the one greatest lien there is? The real estate taxes. It's always #1 priority. It's the only thing in recordings we talk about, the reporting order is what's important. The only thing that can ever get in front of their recorded mortgage is real estate taxes. Every year, and every year, and every year. At the beginning of every year, all of a sudden they got a lien in front of them, real estate taxes. So they're going to require you to pay the taxes every year. And as to these 2 things, insurance and taxes, they are probably going to require you to pay the money to the bank every month so the bank can pay these. That's called escrow. In California, they call them impounds. And in other states, they call them reserves. We call them escrows. Here's what this means. Because the bank is so damn concerned that the insurance be paid for, the taxes be paid for, they charge you every month 1/12 of those. Let's talk about our $1 million piece of property here. On our $1 million piece of property, let's say the insurance, all 3 policies, add up to $12,000. Okay? And let's say the taxes every year are $24,000. Notice these are nicely divisible by 12. Okay, so every month you're going to pay the bank a monthly payment under the note for principal and interest, maybe only interest, maybe some principal and interest, we'll talk about that in a minute, plus 1/12 of your insurance, which is $1,000 a month, and 1/12 of your taxes, which is $2,000 a month. So that what you're going to end up paying the bank is called PITI. And you're going to hear people talk about PITI all the time. It's not pity, it's PITI. And that is your mortgage payment every month. And you're going to hear people talk about properties. What's the PITI? And that's the monthly amount you have to pay the lender. That's the principal, that's the interest, that's the taxes, and that's the insurance. So that every month on this $750,000 loan, you are probably going to pay $8,000 a month for principal and interest, PI, plus $1,000 a month for insurance, and $2,000 a month for taxes, so that your monthly payment is what? $11,000 a month. So the cost of that loan is $11,000 a month PITI. That's because the mortgage says you have to have taxes and insurance, and because we, the bank, are so damn worried that you're not going to pay them, you're going to pay them to us. And we pay the bills every year. That means when the insurance bill comes in every year, the bank will pay. The bank will pay these because you've been paying them $1,000 a month. And you're paying them in advance, by the way. You're paying $1,000 a month so that next year when the insurance comes due, they'll have $12,000 and they'll pay these three bills. And at the end of the year, they're going to have $24,000 in escrow for taxes. So when the tax bill comes in, the bank pays the tax bill too. So a lot of people like this. A lot of people who like to budget their money and pay monthly and don't want to get whammed with a $24,000 tax bill, or boom with a $12,000 bill for 3 insurance policies that all come due at one time. They kind of like paying it monthly, and then the bank pays the bill. Big borrowers, they don't escrow. Big shots say I don't escrow. Big shots say you're not going to hold $36,000 of my money all year long and not pay me interest on it and pay my bills. I'll pay my bills. If you're big and strong, you don't have to pay escrows. If you're not so big and strong, you pay. You pay the bank pays the bills. Because the bank cares an awful lot about taxes and an awful lot about insurance. Okay, mortgages have priorities based upon recording. Simply want you to understand that there can be more than one mortgage on a piece of property. And we already know there can be other claims on property. There can be leases, there can be mechanics liens. This mortgage for $750,000 got recorded on June 1, the day of the closing. The deed got recorded and the mortgage got recorded. The priority of that mortgage is established on June 1. The borrower can then go out in July and get another $200,000 mortgage. That would be a second mortgage, right? And he can go out in September and get a third mortgage for $5,000. Okay? These mortgages have priorities based upon the order in which they're recorded. First mortgage, second mortgage, third mortgage. Recording priority, just like we talked about recording priority of deeds. Whoever records first is first. Whoever records, so the point is they all have claims against the property. But this guy has a first claim. This guy has a second claim. This guy has a third claim. In addition, other stuff happens. Judgments get recorded. Tax liens get recorded. Everybody's priority is established on whether they were recorded before or after June 1. What I'm getting at is leases. If a lease was signed May 1, it has priority over the mortgage. What that means is if the bank forecloses, they can't kick the tenant out under that lease. But a lease that was signed on July 1, the bank can kick them out. Priorities based on order of dates in which they took place. Mechanics liens. There's tons of litigation on mechanics liens versus mortgages on who has priority. It's a real complicated issue. We're not going to get into it. But of course, we talked about what about mechanics liens getting recorded and whether they can get recorded after the mortgage but take priority in front of it because this guy did work before but didn't get paid till later, etc. There's a lot of issues on priorities. The point is you just need to understand a lot of what goes on in a foreclosure, and we'll discuss that at length next week, is all about priorities, who's first, who's second, and what priorities mean in mortgages is who gets paid first. And that's hugely important because if this property is foreclosed upon, and at the foreclosure sale, it sells for $775,000, well, this guy's getting his whole $250 out of it, his whole $750 out of it, because he had the first claim. The second guy is in trouble. There's not enough money for him. We don't all come in and share a pro rata. Who's ever in first gets paid in full first, and we worry about who's in second. So the point is, priorities between lenders is a big deal, and there can be lots of mortgages and lots of claims, and everybody's priority takes place based on when they got recorded. Okay, I want to talk about default now. We talked about default in the contract context, where somebody didn't do what they promised to do. We talked about a default under a lease, where a tenant didn't pay his rent like he was supposed to. Now we're going to talk about default under a note or mortgage. It usually means you missed a payment. Usually. But there are other types of default. Like, you didn't pay your taxes. You didn't pay your insurance. Those are defaults. In the mortgage, you promised you'd keep the property insured. You promised you'd pay the taxes. If you don't, if you didn't have escrow and you didn't pay the taxes, well, that's a default because you said you would. But the main default is you missed a monthly payment. You said you'd pay $8,000 a month every month, and you didn't. That's a default. What happens when you default? Well, it really hits the fan in a mortgage situation. The first thing that comes into play is the acceleration clause in the documents. And we talked about that, guy looking at it in the note. But here's what that's all about. In that promissory note that we looked at, the borrower promised to pay interest only every month on a certain day of the month. Now, if the borrower didn't pay the June 1 payment of $8,000, actually that's a bad situation. If you signed a loan on June 1, your first payment would be due 7/1. If you didn't make your first payment on 7/1 of $8,000, which is what we said was the principal and interest amount of this loan, the bank can sue you for what? $8,000, right? And then you didn't make your August payment, and that's another $8,000. The bank could file another suit against you for another $8,000. Well, that's a real pain in the neck. Banks don't do that. Banks don't wait every month and sue you every month for a pittance amount. The banks use an acceleration clause. And here's what the acceleration clause says is, when you default, when you miss a payment, or you breach a promise, like you didn't pay the taxes or you didn't pay the insurance, the entire debt is due right now. You no longer just owe $8,000, you owe $750,000 now. And we're no longer interested in your $8,000. Now give me the $750. And if you don't, we'll foreclose. And we'll talk about that in a little while, but we'll foreclose the mortgage and we'll take the property away from you and we'll sell it. And you lose the property. Acceleration clause accelerates the balance. There was a maturity date in there of 2.5 years. Well, we accelerate that maturity date and we bring it all back to right now. You defaulted, You missed a payment. Your maturity date is now. The bank accelerates the balance. It is a term that makes sense, accelerating the due date so that the whole thing is due right now. That's hugely important to banks. You need to know what that clause, what that means, what an acceleration clause is and what it does and why it's important to banks. Because otherwise they'd have to sue every month. When you've defaulted, you have, as a borrower, a right of redemption. And the right of redemption is that you always have the right, up until a certain point, to come in and go ahead and pay that full amount due. Not the $8,000 anymore, the $750,000. As the bank goes into this proceeding and is foreclosing the mortgage, which we'll talk about, to take your property back and have it sold, you always have the right to pay that $750 and pay the interest and pay the court costs and pay the attorney's fees for the bank's lawyers. So now you owe maybe $770,000. You have what's called a right of redemption, which is a right to redeem the property and keep the property from being sold. That's a basic right you have in common law called a right of redemption. In Florida, it's discussed in the text as a minority. Florida isn't mentioned, but it mentions the minority of the states have a statutory right of redemption, and we have that in Florida too. And what our right in Florida says is that even after the foreclosure sale, for 10 days after the auction, and we're going to talk about the auction and how you get there as the steps in the foreclosure. But the point is, I know you know the drift of basically, there's going to be an auction of the property, and even for 10 days after that auction, you still have the right to come in and pay that $770,000 and keep the property from being sold. Right up until the bank issues, right up until the court issues a certificate of title. Certificate of title is that thing we look at in our title search when we look at deeds, where the clerk actually transfers the title to the buyer at the auction. And right up until the date that certificate of title is issued, in Florida, the borrower has what's called the statutory right of redemption, because we have a Florida statute that says that the borrower has the right to redeem the property. That's what redemption means, the right to redeem the property up until the date the title is transferred by the certificate of title. Now, next week, we're going to talk at length about a foreclosure procedure. And I'm going to walk you through exactly how foreclosure works. So we're not going to get into it now. We're actually going to draw a factual scenario on there, and we're going to walk through the steps of a different factual scenario in this. I'll walk through the steps of the bank foreclosing a mortgage and what actually happens. I want you to fully understand mortgage foreclosure, and we're going to spend at least an hour, maybe 2 hours on that next week before the exam. But I want you to understand now simply that around the country there are 3 types of foreclosures, and you need to be aware of these. The first is called a non-judicial foreclosure. That's not what we have in Florida, but it's what they have in Georgia. It's what they have in these places where they did the deed of trust to a trustee, or a deed to secure debt where you actually deed the property to the lender. The point is, without a court involved at all, that's why it's non-judicial. Without a court involved at all, the bank sells the property, period. Simply, you didn't make a payment, the bank runs an ad, or the trustee under a deed of trust runs an ad, and he sells the property. End of story, you lost it. No court lawsuit involved, no foreclosure lawsuit. That's called non-judicial foreclosure. Most states have that. It's quick, it's cheap, it doesn't give the borrower much rights, but we don't have it in Florida. We have the opposite of that. That would be what? Judicial foreclosure. We do have judges. A judicial foreclosure is what we have in Florida, which is a legal procedure where the bank has to file a lawsuit and the court determines whether or not the debt is valid, and then the court sells the property. But it's all done under the auspices and orders of a judge, and that's why it is a judicial foreclosure. That's the procedure we'll go through next week of how it's done in Florida with the judicial procedure, the judicial foreclosure. There's one more type that's really rare. The text says it, it happens in 1 or 2 states. It's called strict foreclosure. We don't have that, of course. We have judicial foreclosure. Strict foreclosure is there's not even a sale of the property at all. The bank just takes your property. Simply. They don't sell it. They just take it and keep it. They can sell it if they want to, but the point is, you lose it. The benefit, theoretically, of the non-judicial or judicial foreclosure is if by some miracle the property sold for more than the amount due on the debt, well, you get the rest of the money back. You know, excess money. If this property in the foreclosure sells for $900,000, the bank was due $770,000, well, there's $130,000 left over that goes back to the owner because the property got sold. In a strict foreclosure, no, the bank just plain